Stock options and warrants, short selling, long selling with less risk. Chapter 1. Stock options and warrants. The infamous short sell. The average person can short sell by buying warrants today on a company you think is going to lose money. On the expiration date of the warrant, if the company lost money, you have the right to sell those shares at the higher price you agreed upon when you bought the warrant, so you buy the shares the lower price then immediately sell them for the price on the warrant. It's not as glamorous as the movie about Bill Ackerman, the hedge fund manager shorting herbal magic, but the short selling ideology is alive and well. Barry Minkoff is a two-time scam artist. His first idea was a scam carpet cleaning company. In his second idea, he started an information website to out less than honest publicly traded corporations. He realized he had the power to decrease the price of a stock, so he started extorting companies. The deal was, you pay me hush money, I don't report negative stuff about your company. This is the idea of short selling. If you think a company is going down, buy options that enable you to profit from a company's downward spiral. Stock options trading info. Sell high, buy low. Most people think that buying options on stocks, they're only available for some stocks, is riskier than buying stocks, but I read a book that said you can make more money with less risk. When you buy a call option, you're buying the right to buy 100 shares of a stock at a specified price until a certain date when the option expires. If the stock price goes up, you can buy those 100 shares at the lower price in the option, then immediately sell them at the higher price. You have the option to either use your option or let it expire without using it. When you buy a put option, you're buying the right to buy 100 shares of a stock at a specified price until a certain date when the option expires. If the stock price goes down, you can buy 100 shares at that lower price, then the option entitles you to immediately sell them at the higher price previously stated in the option contract. You have the option to either use your option or let it expire without using it. This is the infamous short selling. After this, everything is somebody's theory or strategy which can buy books or training programs about. Stock options, aka derivative investment instruments, are contracts giving the investor the right to buy or sell corporate stock, stock indexes, or futures contracts at some point in time in the future, usually 1 to 6 months. Stock options are a form of financial investment that are basically contracts where the buyer gets the right to buy X amount of stock shares at a preset price anytime during the life of the option. Options are derivative investment instruments, which means that their worth is derived from the worth of the stock they are buying the option on. In a word, options are speculative. You pay a bit of money for X number of options of a particular company in the hope that the price of the stock will rise more than what you paid for the option, then you can cash the option in and make a profit. The leverage is that for a bit of money, you get the option to buy X amount of stock at a preset price regardless of what happens to the stock in the market. If it goes way up, you're sitting pretty. With your options, you have the right to buy X shares of that stock at the lower price stated on your option. Even with this potential leverage, the truth is that most stocks don't rise enough for the purchase of the options to be worthwhile, so they expire unused. One advantage of options trading is that if you buy options as opposed to stocks and the market goes down, you will only lose what you paid for the options. You won't own stocks that will be decimated. Option contracts came on the market in 1973 when the Chicago Board of Options Exchange, more commonly known as CBOE, opened. The CBOE is the main place to buy options, but besides the CBOE, there are lots of different exchanges where investors can trade options. The CBOE is the only exchange limited to options exclusively. The other exchanges sell options as one feature of several investment instruments. The major options trading exchanges include the American Stock Exchange, or AMEX, Pacific Stock Exchange, and the Philadelphia Stock Exchange. The New York Stock Exchange had sold options but has dropped all options trading. The Options Clearing Corporation (OCC) is the regulator and guarantor of options trading. All option exchanges are members of the OCC. There are two major types of option contracts. 1. Put. An options contract where the buyer gets the right to sell, at the strike price, the underlying stock of the option. 2. Call. An options contract where the seller must sell the particular stock of the option to the buyer if he or she wants to use their option to buy that stock. The strike price or exercise price is the agreed upon price of the stock in the option. This is the price at which the stock will be bought or sold if the buyer decides to act on his option. The strike prices are established by the stock exchange where the particular options trade based on some formula they have devised. With an option contract, a buyer pays a set fee called a premium to the seller for the right to exercise an option, either to buy the particular stock in the case of a call or to sell the particular stock in the case of a put. The contract is valid until a set expiration date, after which it is null and void. The hook is that by paying a few bucks for the option, you lock in the right but not the obligation to buy the stock at a set price at a later date. You are hoping that the price of the stock goes way up in the interim because then you buy it at the price agreed to in the contract, the stock option, and turn around and sell the stocks for an immediate profits. If the price goes down, you lose whatever you paid for the options. The good options trader is a good gambler. He's gambling that from the time he buys the options, today, until their expiry date, the price of the stock will change drastically. If he buys call options, he wants the price of the stock to rise. If he buys put options, he wants the price of the stock to go down. If you think you're smart about predicting which way the stock prices are going to go for those stocks that options are sold on, not all stocks have options sold on them. Because you have some knowledge about the nature of that industry, you could make money in options, but otherwise you're just gambling. You're looking for knowledge that tells you that a certain stock X will be volatile one way or another, then using that knowledge to buy options that will enable you to capitalize on it. You pay a low fee, maybe a few dollars per share, for the right to either buy X number of shares of the stock at a fixed price within a specified time period called a call, or the right to sell X number of shares of the stock at a fixed price within a specified time period called a put. You buy call options in a bullish market, buy put options in a bearish market. Stock options are just about as risky as futures trading. Most expire unused and worthless. You need knowledge and savvy to get into it and make money. Options are an all or nothing gamble. If the price of the stock goes up, you win by calling in your options and buying stock at the low price. If it goes down, you lose what you paid for the options. With puts, if the price of the stock goes down, you can still sell your holdings of that stock at the previous higher price. If the price of the stock goes down, you lose what you paid for the put options. You don't have to buy or own the stock when you buy options. You're speculating, so you wait until near the expiration date, then decide what to do then. Options themselves are traded. You could buy 1,000 options at price X for stock Y, then put it on the market and hope another options trader will give you a higher price for them than what you paid. The closer an option gets to its expiry date, the less it's worth. The biggest key for the savvy investor is what is called leverage power. For a few bucks a piece per option, you get to control a share of stock, so if all goes right and your stock rises, you can earn a lot bigger profit than the amount you invested up front. But the bottom line is that most stocks don't fluctuate very much in a several-month period. Options are sold in 100 lots. You're paying the price of the option and protecting yourself somewhat from a possible big loss if you own the stock while keeping your chance to make money open. Let's say you buy 100 call options on company X. If the price of the share goes up, you simply exercise your option and buy at the fixed lower price, thus making money. If the price of the stock goes down, you have lost the money you paid for the options, but it's probably less than if you had bought the stock. For a puts option, if the price of the shares go down, you can still sell your shares at the higher fixed price to the broker you bought the option from, thus preventing yourself from taking a loss. Or, you could buy X number of the stock at the lower price, then sell them with your put options at the higher price, thus making a profit. Anyone can open an account to trade options through a financial brokerage or a bank that has an investment branch for stock trading. If you have a stock account already, ask to be able to trade options. If not, open a stock account with that option. To open a commodity option account, open a regular futures trading account with a futures broker and ask for the option trading option on it. Options for sale are listed in the major financial publications. Most brokerage houses sell them. Try to buy an option with a value as close to the current price of the stock as possible. Try to buy an option with the longest expiration date away as possible. Warrants are another form of stock option that you buy, and they give you the right to buy a certain stock at a specific price up to a certain date. Writing covered calls is a way to make money while a stock is going down. You buy a stock that has options, many don't. Wait until it goes up a bit, then sell options on it for people to buy it at the lower price. Options are a big thing for the players, the people who want to make money fast, but of course you could also lose. Options trading is a highly specialized, complex field. Learn it well before you enter. I read a book on it, but I didn't understand them then, especially the short selling stuff, nor did I want to, because I don't like to complicate my life. You have to spend time on it all the time if you're playing with options. I don't bother with options because if I lose it all, whereas with a stock, there's always the chance for the rebound. I went to a seminar where some guy was talking all kinds of fancy bull with selling options short, when the market goes down, etc. I'm really not interested because I can't be bothered learning about them. If you really want to learn, get somebody to explain them to you. It's hard to learn them through a book. For more information about stock options, contact either the stock exchanges, most of which have an options department, or the futures boards, which sell a lot of futures options. Incidentally, many upstart companies entice employees by offering them stock options, so if the price of the stock soars, they simply buy it at the lower, predetermined options price. Try number 332.632-645 or HG6024 at the library for books about options. Stock options, LEAPs. A type of option on the market is the long-term equity anticipations, LEAPs, simply a long-term option with an expiration time greater than 9 months. Stub stocks, long-term equity anticipation securities, LEAPs, warrants, and special situation option investing are all instruments where you risk some money in the hopes that stocks will increase in value over time and you can cash in on the gains. cboe.com/learncenter/cboe-education/course list. leapsfunds.com, information on a limited partnership investing in LEAPs. Warrants info. Warrants are stock options with a double-edged sword. They could give you leverage to make money by risking only a little, the cost of the warrant, or they could be a risk if the stock tanks. Some so-called experts like warrants, some don't. The concept is simple. They are options issued by a corporation that anyone can buy that enables the buyer to buy a number of shares of the corporate stock the warrant is on at a fixed up until its expiry date. Warrants are usually sold in increments of 3-month time periods. Up to about 18 months max. They are very cheap relative to the price of the stock. They are somewhat similar to ordinary stocks except that they expire. Certificates are issued for them just like for any stock. There can be various classes of warrants for one particular stock, the class depending on the expiry date, the price it's sold for, and the price you have the option to buy it for at any time during the time period the warrant is operational. The exercise price or the strike price is the price at which the warrant owner can buy the particular stock at any time during its operational period before its expiry date. The intrinsic value is the difference between the exercise and the stock price. It can be negative or positive. If the stock price is above the strike price, the warrant is said to have positive intrinsic value and is sometimes termed to be in the money. When the stock price is below the strike price, the warrant has no intrinsic value and is said to be out of the money. Increasingly, many companies are exercising an option called the call feature, which is the right to call the warrant, which means you have to either buy the stock and turn the warrant into the company in exchange for a set price set by the company. They do this when the stock is going up in price because they want the money from selling stocks rather than having people hold onto the warrants. Warrants are great in the leverage sense if the stock goes up in price because for relatively paltry amounts of money like $1 or $2, you buy the option to buy that stock at price for a period of time like 6 months regardless of how much the stock actually rises. This could be lucrative, but the warrants could expire uselessly if the stock doesn't rise much, as is the case most of the time. Some companies issue warrants as part of an initial public offering, but the main reason they sell them is to make money right now by offering people the chance to make money in the future. If the warrants expire without a big gain in stock price, the company keeps all the money free and clear. The most common way to play a warrant is to buy some, hold them until the exercise price is reached, and then buy the stock with the warrants. As I already said, most warrants expire unused, so the rule is don't buy warrants unless you like the stock and expect its value to rise. If you get into warrants, do it like stocks. Diversify. Buy several different warrants. Warrants are different from stocks in the sense that you have to watch the stock after buy the warrant, and if its price goes up, you have to decide when to actually buy the stock. Warrant prices are listed in all the major investment newspapers like the Wall Street Journal, WSJ.com, Barron's, Barron's.com, and the Sunday edition of the New York Times, New York Times. The Investor's Business Daily, at the time of this writing, does not bother with warrant coverage too much. Finally, warrants are increasingly offered in IPOs. In some of these cases, the company offers a unit for sale which is different from one share of stock. It could 1 share plus 1 warrant, 2 shares plus 1 warrant, 2 shares plus 2 warrants, or virtually any combination of the two. Stockwarrants.com. Options exchange websites. CBOE.com. Amex.com. CBOT.com. CME.com. ISE.com. NIBOT.com. NYMEX.com. PHLX.com. Chicago Board Options Exchange. 400 South LaSalle St. Chicago, Illinois 60605. 312-786-5600. CBOE.com. Free pamphlets on how to trade options, characteristics, and risks of standardized options. Options Resources. Options Clearing Corp. 440 LaSalle St. Number 908. Chicago, Illinois 60605. 800-444-4360. OptionsCentral.com. Options websites. 888options.com, 888 Options, Options Industry Council. iVolatility.com, learn about options. 5perside.com. Alaron.com. Altavist.com. AdventuresinCashflow.com. options-training.rutgers.edu. barcart.com. bettertrades.com, option trading. bigcharts.com. mystockplan.com. mystockoptions.com. cboe.com, Chicago Board of Options Exchange. cboe.com/learncenter/cboe education/course list. cbsmarketwatch.com/news/newsroom.htx. cmegroup.com. coveredcalls.com. cpq.com. cyberinvest.com. dailyfutures.com. dtniq.com. elitetrader.com. equus.com. stockwise.com. fintoals.com. firstrata.com/public/n_us/support/FAQs/FAQs options. futures.tradingcharts.com/market quotes. futuresmag.com. futuresoptionsforex.com. futuresource.com. hodley.net/options/options.htm. ino.com. ironcondor-spread.com. marketingpolitico.com/stockoptionstradaing.html. marketsserene.com. mindexpansion.com. numa.com. odlsecurities.com. openecry.com. option-chart.com. OptionClub.com, OptionEtics.com, OptionEticsWorkshop.com, OptionGenesis.com, OptionMonster.com, OPTION-RESEARCH.com, OptionsCentral.com, OptionsSuccess.com, OptionsStar.com, OptionsTrader.com, OptionStradaingOnline.net, OptionStrategist.com, OptionsExpress.ca, OptionsExpress.com, broker, OptionVille.com, OptionVueResearch.com, PacificX.com/quotes, PowerOpt.com, Quote.com, Quotin.com, RPSW.com, RTQ.ThompsonInvest.net, Options Quotes, SchaefersResearch.com, SchaefersResearch.com, Options Trading Information, SchaefersResearch.com/options, SFOMag.com, Spoos2LZ.com, StockCharts.com, StockFetcher.com, StockOptions.com, broker, TheOptionClub.com, TheOptionsInsider.com, ThompsonInvest.com, TRADE-IDEAS.com, TradersMonthly.com, TradeStation.com, TradingOptions.com, TradingTrainer.com, TSSupport.com, WallStreetCity.com,